Hi, this is James Eng of Old Capital, and today we're going to be talking about um, a couple things, but really start with demand of apartments, and then we're going to get into occupancy, rent growth, and sales in the last year. And then sort of in a darker color, I was trying to find a red color here to go with the green, but inflation impacting interest rates, which is going to impact the yield curve, and then potentially a slowdown. So let's jump in here and start. So here's a little bit of an agenda. We'll go through sort of the multifamily market update currently for February 2022, and then we'll jump into the current financing market. So we're going to spend a good amount of time on bridge, and we're going to get into a little bit of the nitty gritty on sort of how these bridge loans are put together and where they end up. So we'll definitely still touch on Fannie and Freddie and recourse bank loans, but we're going to spend most of the time on bridge. So my background, born and raised in Houston, went to school in Austin at UT. I've been up here in DFW since 2006. Started as an underwriter, loan underwriter for GE Capital, and did that for 8-9 years, and then moved over to Old Capital, and I've been focused on multifamily, originating loans close to $1 billion or over $1 billion, and then investing as LP in approximately probably 35 properties. About 10 of those have sold, and now in about 25 of them. So still looking at a lot of deals to invest in and originate. So let's start with this chart. I mean, this chart sort of blows you away, I think, is net absorption. So that's the number of new units leased in the gray bar here compared to the number of completions. So you can see that 2021, 274,000 units were complete, but 617,000 units were absorbed. And so, I mean, obviously it was a big change in 2020. It was pretty light, but then really came on that net absorption. So that's really just the number of new units leased in 2021, and it was double the completion. So what is that going to drive, right? So that net absorption is going to take the occupancies up and vacancies down, right? So vacancies came down significantly. It was sitting at probably about 5%. And then by the end of the year, it was close to 2.5%. So just record lows on vacancy. I mean, this goes back to 2007, and vacancy was sitting at, 6%, 5 to 6% was sort of average. Most people wouldn't underwrite lower than 5%. And right now it's sitting at 2.5. So basically what that means is every apartment, whether A, B, or C, is essentially full right now. And so when you're full, you as an owner, you have a ton of pricing power. And so you can see that, throughout even 2019, 2020, rents were essentially flat, even down a little bit. And then in 2021, you had a huge pickup, right? So you see the amount of rent growth average was about 13% in 2021. So across the board, as these rents are turning over, you're seeing, some of the high markets were like Phoenix, Orlando, stuff in Florida and the Carolinas. That was probably 20-25% rent growth. But then even stuff in the coastal areas, we're still getting pretty good rent bumps. So on average, about 13% in rent growth, right? So you had a huge amount of demand. You had no vacancy, and so landlords started pushing rents, and rents are up significantly now. And what did that drive? That drove just a ridiculous amount of investment sales in 2021. So, the biggest year prior to that was really 2019. That was probably close to 200 billion in sales. And, if you look at the 2021 chart, in the fourth quarter, I feel like we did, close to 200 billion just in the fourth quarter, but, in total, close to 330 billion in investment sales. And so that amount of demand, so whether that was demand that was sort of pent up from 2020, that was a portion of it, whether it was demand coming from office or retail or other sectors, maybe hotels, that was just pouring into multifamily, that was driving the amount of investment sales that came up. And then the cap rates, with that much demand on the buyer side, you're seeing cap rates continue to go down. And, it's just a huge year for multifamily. last year. And so there was 335 billion in investment sales. And where did all that money end up? It really ended up in Dallas, 28 billion, Atlanta, 20 billion. There's some in LA, 18 billion. But just a huge amount of really, I mean, LA and New York are still big markets, but really, for Dallas to be the #1 market in 2021, that's a huge number for Dallas, 28 billion. Atlanta, 20 billion, Phoenix, 16 billion. I mean, these are huge numbers for investment sales in 2021. And so you can sort of see, all right, where did people move? So the darker blue is where people moved in terms of migration. You can see sort of the Carolinas and Florida, Texas, Arizona, Nevada, Utah, Idaho. That's where people are moving. And that's really where the rent growth is going to be. So where you see these green projected rent growth, you see the same areas, right? So you see, Austin, you see Arizona, Phoenix, you see Utah, you see sort of South Florida, see Carolina. So obviously the migration to Texas continues. And so I wanted to highlight a couple of sort of year-end stats for the major markets in Texas. I spend a lot of time in Texas, and that's where I invest. So I want to show some slides here to give people an idea, because a lot of people think, all right, Texas Triangle, everything's the same, but it's not really the same. So when you look at Austin, look at the effective rent. So across, this is all of Austin, right? So $1,600 effective rent. And then occupancy 96%, and then household income 87,000, price per unit 200,000, cap rate's about 4.2. So keep those numbers in mind as we roll through these slides. And this is probably the last. So we looked at that chart of absorption versus deliveries on a national level. And so we're going to look at that on a local basis too. So you can see that the absorption was 19,000 compared to 13,000 in completions. And so that's going to come a little bit more in balance in 2022 is what they're forecasting. But, on average, Austin's about 200,000 a door, cap rate 4.2, and median household income about 87,000. So, all right, you go down to DFW. So DFW is a little bit more spread out, bigger market. Effective rent's about 1,400. Employment is about 4 times the size, right? So a lot of times people think, all right, Austin's huge, it's growing, but 3 times the national average. But it has about 1.2 million in employment, whereas DFW has about 4 million, right? So if you look at just the employment, the size of the market is significant. So $1,400 average rent, median household income is about 80,000, and then average price per door is about 180, cap rate about 4.6. So it's going to be about the same, flat in terms of deliveries versus absorption is forecasted for 2022. Next market you go down is the Houston. Employment about 3.2 million, effective rent 1,250, lower household income and lower price per door and a higher cap rate, right? So Houston definitely had a huge year. I mean, if we go back to the investment sales, see if we can find it. Houston sold 16 billion. That's a huge number for Houston in terms of the amount of transaction volume. So if you look at year over year change, 383%. So basically nothing sold in Houston in 2020 because of oil, because of COVID. But in 2021, it came back huge. So it's a big number for Houston. It's 158 a door, cap rate about 4.8. And then you can see, deliveries were significantly higher in 2020 than the absorption, but a lot of that came back and reiterated back down to each other in that piece. And then let's go down to San Antonio. So San Antonio, about 1 million in employment, median household 66,000. So that's the lowest out of all the markets here, 66,000. And then price per door is about 123 per unit and cap rate about 5.1. So you can see it's been pretty much in balance. In 2022, it looks like there's going to be more deliveries than absorption that they're forecasting here. So that might put a little bit of pressure on the Class A stuff in San Antonio. So it's sort of a walk around Texas just to give people an idea of sort of, all right, based on the market that you're in, what are we seeing and what are we forecasting for the next year? And so all of that stuff was great, right? I mean, migration's coming in, the sales are there. So if we go back to the chart at the beginning, right? So we had demand of the absorption, we had the occupancy increasing, we had rent growth increasing, and that all led to sales, right? So now we're going to talk about inflation, interest rates, yield curve, and then potentially a slowdown and what could drive that slowdown. So if you look at inflation, I mean, this number just came out in January, north of 7%. You know, in the last recession, the highest was about 5.5%. So when COVID hit, so much money went into the system. So much money chasing so few goods, the same thing as in multifamily. Pricing is going to go up. So CPI has gone up to 7%. And so, you know, the Fed's mandate is really to keep it at 2%. And so they've had to signal, all right, we're going to keep raising rates, right? So here's the federal funds rate. I mean, it essentially sat at 5%. And then, you know, in the last recession, they took it down to 0. And then 2016, they started raising again, all the way up to about 2.5%. And then I can't remember exactly why they started dropping, but they started dropping in 2019. And then boom, since COVID, it's been flat, basically at 0 right now. So right now it's essentially 5 basis points, 10 basis points on federal funds. So 8 basis points right now is the last time we looked at it. So here's the forecast. So it's sitting at 0 right now, or basically 0. And pretty much everybody is signaling, you know, 25 to 50 basis points increase. So if we look here, February 2022, and then by next year, you know, it could be at 2%, right? So for LIBOR, you know, the Fed is projecting here. This is more the market. So anywhere in here, it could be between 1 and 2%, your SOFR and LIBOR rate. And so all these bridge loans that people are doing are based on this rate. So unless you buy a cap, you know, 6 months ago or a year ago, and you capped it at 1% or 2%, your rate could be moving up quite quickly. And then in 2 years, they're expecting it to be at 2%, right? So if your spread is 300 basis points today, you know, your rate is 310. And then by, you know, 2 years from now, it could be 510. So this is putting a lot of pressure on the front end of the curve. Okay. So the front end of the curve really is consisted of, you know, the 1 month, the 3 month, and then also the 1 year and 2 year. And so this is probably seen, so 10-year treasury has moved, right? So 10-year treasury, a lot of people look at 10-year treasury because Fannie and Freddie are basing their rates on that, right? So if you look at 10-year treasury over the last year, it's gone from, here it is in February 2021, so 1.5. And then currently it's at 2%, right? So 1.5 to 2%, that's the 10-year treasury. So it moved up 50 basis points. You're like, oh man, that's a pretty big move. But you go down to 2-year treasury, right? So 2-year treasury was at, I don't know, 25 basis points in 2021. And then boom, it's all the way up at 1.3, 1.4% right now. I think before this yield curve was updated, 1.5 was this morning. So that has like quadrupled, or I can't do the math, but yeah, 4 or 5 times X. So imagine if 10-year treasury did the exact same move where it went from, you know, 1.5 to, you know, 7%. Everybody would notice that. But nobody has really noticed this 2-year treasury popping up this much from 0.25 up to 1.5. And so that movement is going to, so usually you want a yield curve to be up and to the right, right? And you can see that in February 2020, the front end of the curve was significantly higher, or essentially it was like a flat yield curve or an inverted yield curve. So that's why we really get into this chart. So this is when the 10-year treasury minus the 2-year treasury basically goes negative. So that's an inverted yield curve. It has effectively predicted the recession on, you know, the last, let's see, 1, 2, 3, almost every time there's been an inverted yield curve, there's been some sort of recession. And so it happened in 2008, happened in, you know, 2019, before the dot-com bubble. So for whatever reason, this projects the next recession. And I think people are just afraid of the risk that's going to happen with the slowdown. So essentially, if the Fed raises the rates that fast, it's going to cause a slowdown. And so that's why when it has this inverted yield curve, it's going to predict the next recession. So this is the way it's moving. That distance between the 10-year and the 2-year Treasury is narrowing. So this is one thing to keep in mind as you go about your investing this year, is that if that does happen, are your investments sort of set up to do well, even in sort of maybe a very short recession or maybe a long recession. So we'll transition from sort of the market update into financing. And, these are really the top 5 ways that people are acquiring assets on the multifamily side right now. And we're going to start on the right-hand side and move to the left and spend most of our time here on non-recourse bridge. That seems to be the hottest thing right now. And then we'll talk about Fannie and Freddie and then bank loans. And so if you're talking about bridge loans, what happens with bridge loans is essentially you are, the lender originates the loan and then they securitize it to a market called the CLO market. And this CLO market is in gray, right? So in 2020, you can see that it was very small, right? So 2020 is this little gray bar. And then 2021, you can see that the bar has increased significantly. I mean, in 2021, first quarter, it was probably the same amount as all of 2020, right? So this is how bridge lenders essentially get their money, right? So they did that in Q1, Q2, Q3, Q4. So a huge amount of volume coming from the CLO market. And that actually diminished how much sort of Fannie and Freddie did in second, third, and fourth quarter compared to what they did in 2020, right? So in 2020, the only game in town was Fannie and Freddie. Even though you had to put up COVID reserves, there wasn't this CLO market that was available. And so that's why there's been so much liquidity on the bridge side and interest rates are so low, right? So if you're able to go to the CLO market and securitize, you can offer lower interest rates. So this shows a trend of sort of what investors are requiring from these CLOs. And so AAA is the highest rated, so this is the most protected. Triple B is the first loss position, right? So, AAA tranche was starting at about 80 to 100 basis points at the beginning of 2021, and it ended at about, 130 to 180. So all that means is that the AAA people who are buying the safest piece of the tranche of the CLO is they wanted a higher spread. And the people who were taking the first loss position, they also wanted a higher spread, right? And so if they want a higher spread, then you as a buyer, when you go get a bridge loan, you're going to get a higher spread. And so that's exactly what we start seeing. At the beginning of the year, there was a lot of competition, and so of 2021, and so the spreads kept going down and down and down because they were very comfortable in the CLO market. And then what we're starting to see now is if the investor wants more spread, then bridge lenders will have to charge higher spreads. So we're seeing spreads around 350 to 4% right now, depending on the size of the deal. And so there's a lot of new lenders still coming to the market. But this leverage piece, what we don't see is you can dig into some of these CLOs and figure out what leverage they went off at. But the more risk that they see, the higher premium that they're going to request, right? So this, November 1, there was 180 on the AAA and 500 on triple B. They probably had higher leverage loans in that one and potentially, riskier collateral from their standpoint. So non-recourse bridge lenders are definitely still in the market. They're still looking at that yield. They're still pricing over SOFR, but their rates are going to be a little bit higher, especially for smaller deals. So 5 to 10 million, those deals are going to be probably LIBOR, SOFR plus 400 to 450. And then if you go to secondary markets, it's going to be that pricing as well, even for larger deals. So, but this is a conundrum for everybody, is that, Fannie and Freddie, they're still sizing off a 125 debt service. And, based on today's in-place cash flow, you really can't get that much leverage. You're at 50 to 60% typically, and then bridge is still sitting at 75 to 80%. So a lot of people still using bridge, but just be careful. Underwrite, higher closing costs. The interest rate caps are going to be higher, but your leverage will be significantly better, probably 70 to 80% on most deals. On bridge loans, you're going to need, T12 rent roll OM, which is standard, but then also your CapEx, your pro forma, and then they're really going to hone in on your track record and your pro forma rents, and then making sure that your comps are there to support your purchase price on these bridge loans. So here's an example of a bridge loan that we closed at the end of last year. This was a close to $7-8 million loan. So it's right at under 10 million. So SOFR plus 400, 3 plus 1 plus 1, 5 years of IO, 80% of the purchase price, 100% of rehab. And so this is probably the piece that is moving up quick, right? So the first 2 years are really a little bit lighter, but then the third year is where a lot of the cost is. And so you can compare, like, let's say you have a 2% strike, that third year is pretty much all the cost of that strike, even at the higher pricing. So if you can buy a 2-year cap, you can buy a 2-year cap, it'll be cheaper, but you are at risk in that third year, and they will probably require an escrow of some sort on that interest rate cap pricing. But I would build in some definite, whether it's 100,000, 200,000 on your interest rate cap pricing, you're definitely going to need it on these bridge loans to buy that. So that's bridge loans. Let's jump over to Fannie Mae. So Fannie Mae is based off of corresponding treasury. And most of the deals on Fannie Mae are going to be fixed rate, with the exception of floating rate loans. They can do above 15 million. So what we're seeing a lot of people do is sort of fixed rate with maybe a 7-year yield maintenance or step down prepayment. So I think that's a good strategy. On these fixed rates, you don't have to buy an interest rate cap, obviously. So that saves you maybe 100 or 200,000. But you do have a little bit higher prepayment penalty. So you can see rates right now with 10-year treasury at 1.95 to 2% right now. Their spreads. So let's say you do a straight yield maintenance, it might be 4% rate. You do a 7-year yield maintenance, might be 4.10. And then if you have a step down prepayment, it's like 4.27. So you can see that compared to a year ago, where rates were like 3.25, it is 75 to 100 basis points higher right now on Fannie Mae. So that makes it even harder to size some of these loans right now, just because rates are moving up on you. This was an example of a deal we closed last year. Towards the end of last year, we did a floating rate. It's close to a $20 million loan, 4 years IO. It was a 60% LTV, so they have plenty of equity. And then they did floating rate SOFR plus 254. So, right now their rate's 260, and they bought a cap probably in that 1.5%. And so the highest that it'll ever go is 4% for the first 3 years. And then they'll have to decide, all right, do I buy another cap, or do I sell the deal because they have a 1% prepay after a 12-month lockout? So if you have a significant amount of equity that you can put down on some of these deals, then that strategy works. All right, let's go to Freddie Mac conventional. So this is over 7.5 million. They have fixed and floating on this product. Every deal's got to go to Freddie, so it takes a little bit longer, and they're a little bit more conservative on their underwriting than Fannie. And for foreign guarantors, they have a higher post-close liquidity requirement. So make sure you're aware of that. So rates, same thing as Fannie and Freddie. Sorry, same thing as Fannie. Rates are moving up probably 75 to 100 basis points right now on Freddie. This was one deal that we closed. Similar thing, SOFR plus 287. So if you want a floating rate that is inside of 7.5 million to 15, then majority of the time you're gonna have to go with non-recourse Freddie. So that's what we did on this one. We were able to get 70% LTV. So this was back probably summer 2021. So we were able to get 5 years IO at 70% LTV on this deal. All right, let's go down. So if you're in that $1 million to $7.5 million range on your loan amount and it's stabilized, you can do Freddie Mac SBL. So obviously this one needs to be updated, so it's not 175 anymore, but 195 on the 10-year treasury. And that's what it's going to be driven on. And it's going to be focused on local sponsors with experience. Every deal has got to go into Freddie. Right now, they have about a 2 to 3 week time frame for approval. So make sure if you're doing an acquisition, you have at least 60 to 75 days, most likely. This works perfectly for refinances. So if you have a recourse bank loan and you want to refinance into something non-recourse, a little bit longer term, this offers 5, 7, and 10-year terms at fixed rates. So, so Freddie SBL doesn't move. They release pricing every week, and they usually lag the market. So these will probably be up 15 to 20 basis points by the time you get your next deal done. So it's probably 375 to 425 right now. But you can see that you can get a 5, 7, 10-year fixed, and then get IO and 30-year amortization, which for a deal this size is actually very good. So I think if you can buy deals in that $7 to $10 million range with a Freddie Mac SBL right now and still get 65 to 70% leverage, I think that's a very good play, because the cost of these loans is actually so low compared to bridge loans. If the deal can work, I would try to fit it into the Freddie Mac SBL bucket. All right. So this was the deal we closed in Denton, 95% occupied. Loan was right at 74% LTV, 7-year term, 2 years IO. Had about 3.5 interest rate, and then it was fixed, and then step down prepayment. So that gives you a lot of flexibility if you want to exit the loan early, and then you have a fixed rate. So the overall costs, closing costs were probably 2 to 3% on this deal. And then recourse bank loans, we're seeing more people get comfortable with recourse just because of the timing. So these can close a lot faster, lower prepayment, almost no prepayment, and then lower legal and closing costs. So if you're in that sort of $1 to $10 million range, take a look at these as well if it doesn't fit Freddie SBL at this time. So sometimes Freddie SBL, they're going to need a 125 cover. And so if you don't hit that 125 cover, it might only be 50% or 60% leverage. Some people are going to recourse bank loans, and that way they're able to get 75%, and the rates are probably 375 to 425 right now, maybe 4.5 if it's secondary market, but primary market, you're probably still in the 4 to 425 range. And it's fixed, and you don't need to buy an interest rate cap. So here are some of the loans that we closed just probably in the last 6 to 12 months. It ranges from A stuff that's 200 units all the way down to B and C stuff that's 30 to 40 units. So we do a wide range of transactions. We are a mortgage broker, so we work with all these lenders. So Fannie, Freddie, Bridge, CMBS, HUD. We have a speaker series, we have our conference, podcast. So we do a lot of stuff that helps you sort of before the transaction, during the transaction, and then after. So definitely reach out to us with any of those needs. So a couple things, if obviously you like this video, subscribe to the YouTube channel. That helps find other multifamily investors that need information like this. And then if you need a term sheet, definitely let me know. What I need is a T12 rent roll, OM, or address, whisper price on the deal, and then we can turn around a loan term sheet. If you're looking at investing in a deal, you can definitely send me an email, and we can go through the investment package from the general partner. And then, the first step really is completing a personal financial statement, setting up time to talk with me to discuss, buying your next deal. And then, at Old Capital, we're constantly hiring new people. So if you're interested in joining Old Capital, definitely send me an email with your resume. And that is it. So I appreciate everyone's time today. And we will open it up for questions now.